Now let's discuss checklist before trade initiation. Having a checklist is very important, and another important thing is having a trade journal and trade review system. Like in medical profession, we conduct prospective and retrospective studies. In trading also, we need to do these studies. We have to keep record of our trades and check their performances. We will discuss about this later, but now we should know what things are needed to be entered in journal, and we should know which parameters should be used to take trades. So here is a list. First, we need appropriate opportunity to initiate options trade. Then we need to check liquidity, volatility, and depending upon volatility, we have to choose strategy. Last step is to determine reward to risk ratio. Let us see these aspects one by one. First step in checklist is to identify opportunity. Opportunity can be identified based on technical analysis, option chain analysis, or based on indicators. Technical analysis means study of charts, study of price behavior. Based on simple technical analysis like trend lines, support and resistance, swing high and swing lows, one can determine trend. Most important aspect is to understand the trend and stay in direction of trend. Many people try to trade based on option chain analysis, max pain levels, put call ratio. We will study how to analyze option chain and other parameters as well. It is helpful, but option chain may change within 10 to 15 minutes even in high open interest assets like index options. So it is important to keep track of option chain. Many people use indicators. I will tell you a couple of indicator based methods as well when we discuss technical analysis basics. Indicator based methods are useful for short term intraday kind of tradings. VWAP is one important indicator for options trading. Simple moving averages can be used in trend identification. Using these things, we need to identify our setup, whether to be bullish, bearish, or sideways in underlying asset. And once bias is determined, other steps will fall in place. Finding an opportunity is important aspect in trading, but where to find opportunity is even more important. We have to find opportunity for options trade only in optionable scripts. And what is meaning of optionable scripts? Optionable scripts means options trades can be taken in that particular script without worry of whether we will be able to get entry or exit when we want to. Suppose if underlying is highly volatile and options are not liquid, what will happen in that case? We will get stuck in the trade. We will not get opportunity to exit at stop loss which we had decided, or we may not be able to exit at target. If there are no buyers or no sellers, how will we exit? So our aim is to find which are optionable scripts. I had made a list of around 25 scripts which had good liquidity in option chain. Now we will discuss how to find out liquidity in options chain, and then we will create a fresh list. So these are criteria to determine liquidity in options. These criteria are very important to follow. Breaking rules in trading options is very dangerous. It leads to erosion of capital very rapidly. So following are rules to determine liquidity in option. First of all, total open interest in terms of contracts is important. There should be 10,000 contracts to qualify liquid optionable scrip. 10,000 contracts, not quantity. So 10,000 contracts include both puts and calls at all strikes combined. This shows that there are active participants available for trading and one will get buyers and sellers in these scrips. Next criteria is daily volume of at least 300 contracts, both at the money call and at the money put strikes. 300 contracts are minimum and this criteria should never be overlooked. More volume means better trading possibilities. For total open interest, one may consider minimum of 5,000 contracts, but daily volume minimum of 300 contracts at the money is must. We should not look for scripts which have less than 300 contracts volume at the money on both put and call sides. Third criteria is about spread between bid and ask. Spread should not be more than 10% of current market price in any situation. For example, if option price is 70 rupees, then difference between ask and bid should not be more than 7. These are very important criteria. Following these criteria will lead us to 25 or 30 scripts which can be traded in options. This is very good number of scripts for option trading and one should limit to as less number of scripts as possible. Any doubts in this part? Now let's come to strategy selection part. Strategy selection depends upon IV and HV relationship. That means implied volatility and historical volatility relationship. Option selling strategy should be followed for zone 5 or zone 4 volatility. And option buying strategies can be done in zone 1 or zone 2 areas. For option buying on long term basis, one should always do it in longer expiry. Option selling trades in zone 4 and zone 5 are possible for most optionable scripts in India, but option buying for long term is not advisable in any of Indian scripts. Most common reason being not so liquid option chain in far expiry. Index option have expiry more than 90 days in India and they may be traded if liquidity is adequate and spreads are narrow. Now most important question in your mind must be, if we cannot buy stocks options in India, what's the purpose of trading in option? Is it really worth? This is very important to understand. Buying options for intraday trading or with view of couple of days or 1 week is different from buying for longer duration. Buying for shorter duration is possible, but profit booking has to be fast in that case. Some people are buying stock options or index options and usually they buy it for momentum. Their average holding period is usually 15 minutes or so, sometimes maybe up to 1 hour. It is mostly intraday trade and they exit on same day. Targets usually are small and size of trade is also small as compared to capital. One should not risk more than 0.2% of total capital in intraday trade for options. One may think that these rules of buying only in zone 1 and zone 2 or buying for longer expiry are too strict rules and one may not get adequate trades due to these rules. Well, it is better to get less trades but essential to get good trades. Trading means waiting for proper setup and taking action only at most opportune time. Risking good chunk and earning big chunk is better than risking small amounts and trying to get peanuts. Most of the profits wash away in brokerages and taxes to government with this type of trading. We will also discuss those types of trades which are taken based on short-term momentum in indices for small short gains. For small gains of points but large profits due to large quantity traded. Strategies in this chart will be discussed one by one very soon. Now let's see option selection parameters. As already discussed, we should buy options with 90 days to expiry whenever we want to buy for long term. Strike selection is important. For option buying, it is always better to buy at the money options or slightly in the money options. They give fast moves, better liquidity. So if we are looking to buy call options in demand or in buying area, we should buy at the money strike or strike below support level to get best outcome. However, if we are looking to sell put from buying areas with bullish view, then it is better to sell put below support. At the money options and in the money options move rapidly, and if move is against us, we do not get time to adjust position or manage risk when option premiums increase rapidly. So preferably sell out of the money options and buy at the money or slide in the money options. If we are making a strategy for directional trade, then care should be taken to maintain minimum delta of 0.25. Minimum net delta of 0.25. We will discuss what is advantage of this during discussion about strategies. Does anyone have any questions? Reward to risk ratio should be always better. When we are going for debit strategies, that means for option buying strategies which have low probability usually, then we should target for 3-hour trades. 3-hour trade means we should get 3 times reward than what was our actual risk. So suppose we are risking 10,000 rupees, then we should look for targets which are 30,000 rupees or more. Otherwise there is no point in going for that trade. For credit strategies, probability is good and minimum 2-hour trades are acceptable. When probability is very high, then one can take 1.5-hour trade also. So this is very important. For debit strategies, we should go for 3-hour trades. For credit strategies, minimum 1.5 to 2 hours should be available. Now let's come to next topic, how we can decide buy or sell price of options. Options are derived from underlying asset. Our analysis is based on underlying asset when we are taking a trade based on technical analysis. It is better to trade based on these levels of underlying and avoid trading based on chart of options when our analysis is based on underlying chart. Sometimes stop gets triggered on option charts but does not get triggered on underlying chart. So when underlying hits area of action on chart of underlying, then order should be executed in options. There are different types of orders available. Limit orders are best for initiation of options trade when taking an entry. Now let us see how to use orders properly. When we are taking entry, either it may be buy entry or sell entry, we have to see prices in bid and ask. We have to check liquidity and bid ask quantities. When liquidity is adequate and many people are active, then spreads are narrow. If spreads are larger, then it is better not to trade. If spreads are wide but they are within acceptable range, then one can use technique of shaving the spread. What is meaning of shaving the spread? This means entering between bid and ask price. For example, if certain option shows bid at 40 and ask at 42, the difference is of 2 points. This is less than 10% difference. So it is acceptable range. One can place order to buy or sell at 41 to get slightly better rate than market order. If we place market order, our order will be executed for buying at 42, for selling at 40. But if we place order in between, then there are good chances that we may get that order filled. This is very useful technique. Entry can be taken with limit order, but to exit a trade, one must use market order or order at latest bid or latest ask price. Shaving spread should not be done in option trades while exiting. This exit can be for stop loss or booking profits. Sometimes prices run very sharply when they hit stop, or they reverse when they hit targets if stops and targets are chosen properly. So one should not wait too long to exit. It is better to exit at whatever price which is available. Is everything clear? Any questions related to whatever we have covered till now?